Retirement is broken. Most people did what they were told. They worked for decades. They saved. They bought bonds. They bought a home. They trusted the system. Retirement was supposed to be the part where things finally got easier, where the stress went down, where the math worked in your favor. But for a growing number of people, retirement doesn't feel secure at all. It feels fragile. It feels tighter every year. And quietly, it feels like the rules changed without anyone saying it out loud. Today, I want to talk to you about why retirement is broken, why the traditional escape routes no longer work the way they used to, and then walk through one modern instrument, Stretch, ticker symbol STRC, that attempts to solve the retirement income problem in a debasing fiat system. My name is Angel Rios. This is the Debasement Index. Let's build capital in a fiat world together. The retirement system most people rely on was built in a very specific environment. Money held its value. Debt grew slowly. Inflation was low enough to ignore, and yields actually meant something. Back then, bonds paid you real income. Real estate rose steadily without constant intervention, and you could live off the yield without touching the principal. That world no longer exists. Today, the defining feature of the system is simple. Money is being created faster than retirement assets can compound. And that one change breaks everything downstream. Now, let's talk about the bond illusion. Bonds still look safe on paper. They pay regularly, they feel predictable, they feel responsible. But safety in nominal terms is not safety in real terms. If a bond pays you 7 or 8%, but your purchasing power is falling faster than that, you are not earning income. You are solely spending yourself. Nothing dramatic happens, no alarms go off, the account balance looks fine. But year after year, what that income actually buys keeps shrinking. That's not stability, that's erosion. This is the quiet crisis no one likes to name. Retirees don't need maximum upside. They need reliable income. They need capital preservation. And they need protection from monetary debasement. Instead, they're offered bonds that lose purchasing power, real estate that demands active management, and equities that are volatile when income is required. There's a gap between what retirees need and what the system provides them. Let's talk about real estate's quiet shift. For decades, real estate was the escape, and in some ways it still can be. But the character of real estate has changed. Taxes rise with inflation, insurance reprices faster than rents, maintenance costs compound, regulations tighten, liquidity disappears exactly when you need it the most. What used to be a passive hedge has become an operating business. For retirees who need simplicity and predictability, that matters. Real estate didn't become useless, it became work. Now, let's talk about how we fix this. Well, enter Stretch, better known as STRC. It's a preferred stock issued by the company Strategy. It exists for one reason and one reason alone, to provide income. Not growth, not speculation, not hype. It pays an 11% yield and sits above common equity in the capital structure. This matters. Preferred holders are paid before common shareholders. They are not chasing upside. They are paid to provide capital. STRC is designed for people who care more about cash flow than price appreciation. How it actually works? Well, preferred stock lives between debt and equity. It doesn't promise perfection, but it changes the risk profile. Strategy generates capital elsewhere through volatility, through leverage, through balance sheet strategy, and offers stability to those who want income instead. In other words, some investors take the swings, others are paid to stay calm. STRC is built for the second group. Now, what are the risks to Stretch? This is not risk-free. There is company risk, exposure to Bitcoin through the issuer because Stretch is a Bitcoin backed collateral asset, interest rate sensitivity, liquidity considerations. It is not a bank account, it is not guaranteed. But pretending traditional retirement assets are safe while they lose purchasing power is also a risk. STRC doesn't remove risk, it reprices it. This is how this fixes this part of retirement. STRC is not the solution to everything. It does not replace Bitcoin as a long-term protection, gold as monetary insurance, growth assets for compounding. It fills a missing layer, income in a broken monetary system. It allows retirees to generate cash flow without selling assets, without chasing volatility, and without pretending debasement isn't happening. So, naming the truth. Retirement isn't broken because people failed. It's broken because the monetary system changed, and most retirement tools never adapted. Once you understand that, the confusion lifts. If you're trying to protect purchasing power, generate income, and think clearly in a debasing fiat world, this channel exists for that. This is the Debasement Index. My name is Angel Rios, and let's build capital in the fiat world together.